Real estate investment trusts, or REITs, finished last year as one of the S&P 500's top-performing sectors, generating a total return, price appreciation plus dividends, of plus 46.2% versus plus 28.7% for the index as a whole. Investors positioned in the best REITs could be set up for even more outperformance in 2022. Let's have a look at 10 real estate sector stocks to buy now. Number 10. American Tower. American Tower, or AMT, is one of the world's largest owners and operators of multi-tenant cell towers and related infrastructure. The REIT owned 219,000 communication sites worldwide, with large concentrations of cell towers in India, 75,000 cell towers, the US, 43,000, Brazil, 23,000, Germany, 14,700, Spain, 11,400, and Mexico, 10,100. Cell towers can be highly profitable because they can support multiple tenants on the same structure. The REIT estimates its return on investment, or ROI, at 3% for one-tenant towers, 13% for two-tenant towers, and 24% for three-tenant towers. Number 9. Americold. If you prefer the large moats of niche real estate, Americold, COLD, is one of the best REITs you can buy. Americold is the world's largest real estate investment trust, focusing exclusively on temperature-controlled warehouses. The company owns 246 cold storage warehouses, representing 1.4 billion square feet of storage capacity, which it leases out to approximately 4,000 tenants. Americold estimates that it holds a 22% share of the U.S. cold storage market. Number 8. Digital Realty Trust. Digital Realty, DLR, isn't just one of the nation's largest digital REITs, it's one of the nation's largest real estate stocks overall. This REIT owns a global portfolio of 291 data centers that serve more than 4,000 corporate and government customers. This company mainly serves Fortune 500 firms. Its top 20 customers include IBM, Meta Platforms, Oracle, LinkedIn, JP Morgan Chase, Comcast, and Verizon. Customer retention rates average around 80% and are likely to remain high due to high switching costs, $15 million to $20 million, associated with moving megawatts of data to a new facility. Embedded 2% to 4% annual rent escalators and strategic acquisitions supported by Digital Realty Trust's investment-grade balance sheet have made it one of the best REITs for decades. DLR boasts 11% annual growth in core FFO per share since 2005. Number 7. Plymouth Industrial REIT. Plymouth Industrial REIT, PLYM, owns distribution centers, warehouses, and industrial properties located primarily along the main logistics corridors of the U.S. in secondary markets, including Kansas City, Indianapolis, Chicago, Cleveland, and Columbus. The fragmented nature of industrial real estate in secondary markets has helped the REIT to acquire its current portfolio at 55% of replacement cost. In the last 5 years, Plymouth has closed nearly $900 million in real estate purchases. In addition to lower purchase costs, the REIT's focus on secondary markets has created above-average opportunities for rental growth. Plymouth had 4.7 million square feet of new leases commencing during the first 9 months of 2021 at rental rate increases of 9.7%. The REIT's current real estate portfolio consists of 152 properties, representing 26.6 million square feet of leasing space. Number 6. UMH Properties. This REIT is the nation's leading owner-operator of manufactured housing communities. It owns 127 manufactured housing communities containing 24,000 developed home sites across 10 states that are leased to residential homeowners. In addition to home sites, UMH owns a portfolio of 8,700 rental homes and plans to grow its rental unit portfolio by 800 to 900 homes per year. With 3,300 existing vacant lots to fill and nearly 1,800 acres available to build lease sites for another 7,300 homes, UMH has plenty of room to grow. Number 5. Stag Industrial. Stag has grown through a combination of rent increases and acquisitions and is guiding for roughly 3.5% same-store growth in 2021. If it hits that target, that would make the highest same-store growth in company history. The REIT has benefited in 2021 from rent escalators, shorter downtimes between leases, and 75 to 80% tenant retention rates. Acquisition volume forecast at $1.1 billion to $1.2 billion in 2021 would also be the highest ever for this REIT. E-commerce has been a powerful growth catalyst. Stag estimates 40% of its portfolio is engaged in e-commerce fulfillment. Amazon.com is its largest tenant at 3.6% of the portfolio, and other tenants include Eastern Metal Supply, GXO Logistics, FedEx, and American Tire Distributors. Stag offers a solid balance sheet, 7 consecutive years of dividend growth, and a conservative 70% FFO payout ratio. Compared to the other best REITs on this list, it's hardly a steal at 21 times AFFO estimates, but shares still appear moderately priced. Number 4. Essential Properties Realty Trust. Essential Properties Realty Trust, EPRT, invests in single-tenant net lease properties across 45 states. Net lease refers to a lease structure where the tenant pays all property expenses. EPRT owns 1,397 properties, representing 12.4 million square feet of space, and leased to approximately 300 tenants. Its tenants come from 17 different industries and are primarily service businesses, such as medical, dental, automotive repair, casual dining, and childhood education. Many of these are e-commerce resistant. The portfolio's weighted average occupancy was 99.9% during the September 2021 quarter. Essential Properties is proactive in managing its portfolio. Growth prospects make EPRT one of the best REITs to buy in 2022. The company expects to end 2021 with 18% adjusted FFO per share growth. On top of that, it's guiding for another 13% improvement in 2022, which should also help it bolster the dividend. Number 3. Store Capital. Another net lease firm dotting for the best REITs for 2022 is Store Capital, STOR, which owns single-tenant properties across the U.S. This REIT targets middle-market customers like Camping World, Bass Pro Shops, and Spring Education Group that typically generate more than $50 million in annual sales and generate a third of their sales from repeat customers. Store owns 2,788 properties that are leased to 538 tenants and enjoys a 99.4% occupancy rate. And with more than 215,000 businesses nationwide fitting its target customer description, Store Capital has plenty of opportunities for growth. Portfolio security is helped by longer than average leases, with Store's weighted average remaining lease term at 13.5 years. Number 2. Iron Mountain. Iron Mountain, IRM, built its original business around the physical storage and shredding of records, though it has for years been transitioning to digital data storage. This REIT has unmatched scale in physical records, storing documents for approximately 225,000 customers, including 95% of the Fortune 1000 companies. In this business, Iron Mountain boasts a 98% customer retention rate, consistent organic growth, and 15-year average relationships with customers. Iron Mountain is using the reliable cash flows from physical record storage to build digital data storage capabilities. At present, The REIT operates 15 data centers that have 445 megawatts of potential information technology capacity and serve more than 1,300 customers. Approximately 144.7 megawatts of its data center capacity is already leasable, and the REIT has another 66 megawatts under construction and 234.8 megawatts held for development. Number 1. Medical Properties Trust. Medical Properties Trust, or MPW, operates hospitals, inpatient rehabilitation centers, and behavioral health facilities worldwide, and is the industry's second largest non-government owner of hospitals. The REIT owns 442 medical properties across 34 states and 9 other countries, which are leased to 52 healthcare systems in the U.S. and overseas. Acute care hospitals are the backbone of a portfolio valued at $21.4 billion. Medical Properties Trust's largest tenant is Steward Healthcare, which leases 36 properties and represents roughly 2.6% of the portfolio. Let us know in the comments which one of them you would like to invest in. Please subscribe to The Stock Advisor. Thanks for watching.